Many investment experts recommend keeping a portion of your portfolio in cash. The strategy is simple. Wait for a market crash, then deploy your reserves at the bottom. Warren Buffett's Berkshire Hathaway currently holds $347.7 billion in cash. Benjamin Graham advised keeping at least 25% in bonds or cash equivalents. But does this advice actually work for individual investors? Today we'll test it against 26 years of real market data. First, some context. Stock market crashes aren't the exception, they're the rule. Since 1928, the S&P 500 has experienced 27 bear markets, defined as a 20% or greater decline from the peak. That's roughly once every 3.5 years. The average drawdown was minus 35%, lasting an average of 9.6 months. The Nasdaq tells an even more dramatic story. During the dot-com bust in 2000, the Nasdaq Composite plunged 78% from its peak. It took a staggering 15 years to fully recover. The S&P 500 dropped 57% during the 2008 global financial crisis. And in March 2020, the COVID crash sent the S&P down 34% in just 23 trading days, the fastest bear market in history. Looking at these numbers, holding cash and buying at the bottom sounds like the smart play. And in fact, the investment legends did exactly that. When Lehman Brothers collapsed in 2008, Buffett invested $5 billion in Goldman Sachs and earned $3.7 billion in profit. He received a 10% annual preferred dividend and $5 billion worth of warrants, the right to buy shares at a fixed price in the future. Howard Marks Oaktree Capital raised a $10.9 billion distressed debt fund, a strategy of buying bonds from companies on the brink of default at deep discounts, and delivered a net return of 31.5%. These trades were only possible because they had cash on hand. So shouldn't we follow the same strategy? To answer this question, we ran a simulation using real market data. Here's the setup. You hold 25% of your portfolio in cash. That cash earns 2.5% annually in T-bills, short-term U.S. government bonds. When the market drops a certain percentage from its peak, you deploy all your cash. When your deployed capital gains a certain percentage, you pull it back to cash. We ran 35 combinations using actual weekly S&P 500 data from 2000 to 2025. The vertical axis shows the deploy threshold, how far the market must fall before you invest your cash. The horizontal axis shows the withdrawal gain, how much profit triggers you to pull back. The results were shocking. Out of 35 combinations, only 13 beat buy and hold. The other 22 performed worse than simply doing nothing. Over 26 years, a buy and hold investor's $10,000 grew to $47,490. Yet two-thirds of these timing strategies couldn't match that, even with T-bill interest on the cash. Could the cash allocation be the problem? Is 25% too much? We tested every ratio from 5% to 50%. The result was identical. Whether you hold 5% or 50% in cash, only 13 out of 35 combinations beat buy and hold. That's a 37% win rate. The cash ratio doesn't change who wins and who loses. It only changes the magnitude. Why does the cash strategy lose to buy and hold? The core reason is cash drag. The S&P 500's 26-year annualized return was 6.2%, while T-bills averaged 2.5%. When 25% of your portfolio earns 2.5% instead of 6.2%, you're giving up roughly 0.9 percentage points every year. That sounds small, but compounded over 26 years, it creates a massive gap. And our simulation was actually generous. We assumed perfect discipline. deploying cash instantly and fully the moment the market hit the threshold. No hesitation, no fear. In reality, when the market is down 30%, most people freeze. They worry it'll fall another 20%. Real-world results would likely be worse than our simulation. J.P. Morgan Asset Management's research confirms this. A $10,000 investment in the S&P 500 over 20 years grew to $64,844 for those who stayed fully invested. But missing just the 10 best days cut that to $29,708, destroying 54% of returns. 7 of those 10 best days occurred within 2 weeks of the worst days. If you're out of the market, you miss these critical rebounds. So why did Buffett and Howard Marks succeed with the cash strategy? The answer is simple. They're playing a different game. Look at the deal Buffett got from Goldman Sachs, a 10% preferred dividend and $5 billion in warrants. These are terms that no individual investor will ever receive. It's a completely different transaction from buying stocks at market price. Howard Marks managed a $10.9 billion institutional distressed debt fund. He wasn't buying ETFs in a personal brokerage account. As our 26-year simulation demonstrates, for individual investors, holding cash and trying to time the market is a net negative strategy. The opportunity cost of cash erodes most of the gains from buying the dip. Let's summarize. Holding cash and deploying it at market lows sounds appealing. But when we simulated 35 combinations against 26 years of real data, most of them lost to simple buy and hold, even with T-bill interest. The reason is clear. The opportunity cost of cash is certain, but the gains from buying the dip are not. And even with perfect timing, most strategies still couldn't beat buy and hold. The best investment strategy is the simplest one. Buy and hold. Stay in the market. Let compounding do the work. We'll continue to analyze and deliver data-driven insights to light your investment path. Subscribe now so you don't miss our next deep dive. Thank you.